Hello, I'm Ben Rockell, co-founder and managing partner of Kingsbury and Partners, and this is the third episode in our series with the leadership team and key stakeholders of Alt Lending. And as I mentioned previously, they're a specialist lender in the US student loan refinancing market. Today, I'm joined by Mary Jo, who is the COO or Chief Operating Officer of Alt Lending, and I'm very pleased to be joined by Mary Jo today as we discuss some more topics and our recent partnership with Alt Lending to raise $15 million for a private credit raise to acquire and service a portfolio of ongoing US student loans. Mary Jo, thank you very much. Thanks for joining me this evening.
Thanks for having me.
Perfect. Well, Mary Jo, just to kick off, could you just briefly introduce yourself and your role at Alt Lending and your background in the US student loan market?
Absolutely. Mary Jo Terry. I'm actually the COO of Alt Lending, responsible for all the operations, compliance, and making sure marketing is happening as required. I've been in the education loan market or the student loan market for over 25 years. I actually started while I was in college with a secondary lender servicer, responsible for acquisitions of education loans, whether they were at that time federal loans or they were private loans, deals from 100,000 to 3 billion at any given time. I subsequently left that opportunity and continued in the education secondary market, working with schools and lenders. And lenders at that time could include banks, credit unions, actual states, working with education loans and trying to take borrowers through the education process from the time that they entered college to the time they graduated, and then what to do with the subsequent debt. I eventually opened a company called the Student Loan Processors, and we actually originated and financed over $1 billion annually, both in the federal market as well as the private loan market. Subsequently sold that entity but continued in education throughout my career, but kept running into the situation where borrowers with private education loans that have been defaulted or severely delinquent, in charge-off status, really had no place to go. And so that kind of led me to become a distressed lender. I know there's a lot of secondary lenders in whether it's credit cards, auto loans, mortgages, things along those lines, but really didn't have a market for student loans. And so that subsequently led me to Alt Lending, have previously originated about 50 million in this particular space, but really saw an opportunity with the new President Trump's agenda to really expand that into a substantially larger entity and subsequently partner with Alt Lending.
Fantastic. Thank you very much, Mary Jo. And again, pleasure to be with you this evening. So Alt Lending has a vast opportunity in the private student US student loan market. It's mentioned that there are up to 30 billion in distressed private US student loans, distressed, delinquent, defaulted student loans. And more recently, Alt Lending has made a significant portfolio purchase. Can you discuss sort of the kind of criteria you use to assess the quality of loans? Recently, actually today, I've had a conversation with a potential investor who said, well, how do you ensure that loans are repaid? And that's all down to your underwriting policy, in which we've had a decent chance to have a look at. So could you sort of give us an overview of that and how you ensure you find those borrowers that are of good credit quality?
So one of the things we first start with is where were these loans originated and what school did the borrower attend? We also take a look at the percentage of cosigners that are associated with these loans. And then the third thing is we really take a look at whether the borrower did make payments during school or if the borrower actually went into repayment upon graduation. We're looking to see if these individuals received degrees or if they're really just separated from school or they went on to get additional degrees. So we take a look at all of those individual pieces, and then we also take a look at the balance of the loans that are outstanding that are coming from this particular entity. Because the advantage with us purchasing a portfolio is we now have the opportunity to go to that consumer borrower and refinance that loan into possibly a lower interest rate loan. Sometimes we find that when we purchase these loans, they were sitting at 8 and 9%, when I can get the consumer back down into a 3, 5 interest rate range, which makes a big difference on their monthly payments. So there's a big advantage of us purchasing these loans because we have a history of repayment. We also know the school that they attended, and we also can get a deeper look into their credit history. Oftentimes, an individual that has delinquent or defaulted education loans, they have this with multiple lenders. It's not just one lender. It could be a school, it could be a Sallie Mae, it could be any other institution. And so what we want to do is we want to go in and solve their entire problem and get them down to a single payment. And there's huge advantages to taking a look at these portfolios as an individual, because we also get a lot of repayment history. Where in the US are they located? Are they employed? Are they not employed? So there's a lot of advantages to taking a look at these portfolios.
You mentioned there as well about looking at the schools that they've attended. So from someone from the UK, to me, we've got student finance, England, etc. What's the differences and the nuances there that you're looking for from someone that might be based sort of in the UK, Europe, and Asia?
Well, in the US, we have federal accreditation. So that's considered, it's actually called Title IV schools. And what that means is the school actually had to work with the government, the Department of Education, to get approved to receive federal funds. And so that's an advantage for us because we know that they're getting a quality education, they're following federal regulations, and there's a much better chance that this borrower is going to repay. So there's what you call Title IV schools, and that's really important when we're looking at this individual criteria. It ensures that the individual receive the level of education needed in order to get a good job and to enter into repayment. Now, this does not mean it's just a traditional school. This could be a non-traditional school, someone who's truck driving, somebody who's going into auto repair, somebody who's going into trades, so electricians, plumbers. These are still great jobs here in the US, but it's a non-traditional education.
When you're buying these loans, so another question that we get quite often is why are you able to acquire these loans from sort of 15 cents on the dollar to sort of 50 cents on the dollar? Why is the previous lender, that could be credit unions or previous banks, Sallie Mae, for example, why are they selling these loans at such a discount?
That's a very good question. The reason they're selling these particular loans at a discount is there's many, depending on where you're at. So if it's a traditional bank or credit union, there's only a certain percentage of education loans that they can legally have in their portfolio. And once these loans become delinquent and charged off, they're definitely willing to negotiate, get them out of their portfolio, and bring in a decent asset. That does affect the bank and the credit union directly. When you're looking at a college and university, oftentimes that's considered gap financing. They're not a lender. They're not really a bank. They're not a lending institution. That's not their business. And so they're also willing to take a discount because their education costs have been covered by the federal funding that they've probably received. And then the last but not least, Sallie Mae is willing to sell, which is a large student lender, willing to sell these assets at a significant discount because they're just simply recycling their money as they go through. And they don't really want to carry all this bad debt sitting out there. They've got securitizations, they have stakeholders to answer to. There's a whole number of reasons. So alt lending becomes in and is a win-win-win. So the first win is to the borrower because they're getting out of a collection situation. They're able to get a new loan, which increases their credit. The underlying lender gets a win because they're getting money, they're getting cents on the dollar, they're getting this off their books. And alt lending gets a consumer that's really wanting to repay their education loans and get out of this situation. If you have a low FICO score in the United States, everything you do is more expensive. Your car insurance is more expensive. Your rent is more expensive. The deposits you have to put down on everything is more expensive. And so having the ability to purchase the asset, bring it in from a good institution, assist these borrowers into a new loan scenario where they can make payments and they can increase their FICO scores, and they can possibly create a new relationship with these co-signers who ended up in a bad situation because their son, their daughter, their niece, their nephew got into a bad financial situation. It's a win-win for everyone.
And more recently, you've closed on a portfolio purchase of loans. What are you able to tell us about that particular purchase, if anything?
Absolutely. So they came from a Title IV school. These individuals have been in and out of repayment for 2 to 3 years, which is kind of nice because we see a history there. We were able to determine and select specifically what states were interested in purchasing. There's different collections regulations depending on the individual state here in the US. Each state manages what their requirements are. So we've been able to go in and kind of cherry pick the loans that we're interested in. In the US, it's kind of like you have your tier one borrowers that are in delinquency and default, which means they're new, they're brand new. Then you kind of have your tier two, they've been in delinquency default for 2+ years. But then you have your third, which is you're significantly delinquent, so 4, 5, 6 years. So we're able to go in and cherry pick the borrowers that we really know will repay based on our internal experience associated with this asset class. Myself, as well as my team and the other co-founders of the business, have been in the education industry for 25, 30 years. So we're very familiar with credit criteria. In fact, have partnered with companies like TransUnion to create different algorithms in order to identify the best consumer coming over. So we're going to have a really good high quality portfolio based on those years of knowledge and having the ability to utilize tools that are offered by outside third parties as well as the internal knowledge that we have.
So just to go back a step, Mary Jo, you mentioned about that when you refinance or you acquire a portfolio of loans, it's a win-win-win. So for alt lending, for the previous lender, and also for the borrower as well. What's the impact been from the recent Trump administration?
It's been a really positive impact. So student loans have been in the news here in the US as well as international about loan forgiveness and about the ability to wipe out your federal debt. That is no longer the case. It was pulled back by the Supreme Court. It was confirmed by the Supreme Court that the executive order coming out of Biden or the previous presidents is not sustainable. It did need to be legislated, and it was not legislated. So as a result of that, we have a $2 trillion portfolio sitting out there of delinquent, defaulted, and charged off consumers, which hasn't been collected on in the last 2 years, nor has it been reported to our credit bureaus, to TransUnion, Equifax, Experian. That's changed. So that's going to be a significant difference where these consumers are going to have to pay attention to their federal debt, which allows us and allows them to pay attention to their private debt that is also in a delinquency, default, or charge-off status. So what we're going to see is more consumers, good, bad, or indifferent, are going to start to go delinquent or default on their private loans because they're going to have to pay on their federal loans. So what we want to do is come in and offer them a refinance product in order for them to refinance those loans so that they can afford their federal payments and their private payments all at the same time, as well as eliminating who do I pay. If they have 3 or 4 private, they could have a school, they could have a lender, they could have mom and dad, they could have any number. And what we want to do is refinance it into a single loan in a payment that they can actually afford for this particular education debt. Education debt in the US has a very high bar for bankruptcy. So, and the very, very high bar for bankruptcy, most individuals here in the US will not be able to bankrupt out of this debt. They'll continue this debt into your 60s, 70s, and 80s. and wage garnishment, any number of bad things. And what we want to do is try to solve this for the borrower and their cosigner.
Yeah, and I think that we're pivoting quite nicely now to something that I was quite surprised about when we first began our discussions, is the social impact of alt lending and the borrowers that they work with. So how does alt lending balance return and responsibility in this sector?
Well, it's very interesting. Unfortunately, we hear very sad stories every single day of borrowers who never thought they would find themselves in this situation. The amount of debt that they owe is overwhelming. A variable interest rate where the interest rate markets are going up. Maybe they could afford their payments a year and a half ago. They can't afford them now here in the US. And they're ending up in a situation where they're in charge off. These are bad loans. They don't know where to go. They don't know who to pay. And with an exorbitant interest rate, collection fees all added into that loan. And so what we do is we go in and give them a low fixed interest rate. We resolve the issue for the borrower and the cosigners. Sometimes we get children speaking to their parents again. Sometimes we get children
Wow.
speaking to their grandparents again, because they're solving the issue for the cosigners who never signed up to end up in a delinquency or a default or a charge-off situation. Grandparents oftentimes can't afford to pick up that extra $200-300. And so we actually spend a significant amount of time with these borrowers, sometimes on the phone for 45 minutes or longer, walking them through this process and really resolving this situation, giving the parents and the grandparents, even though they may be co-signers on the new alt lending loan, they know it's going in a positive direction. And that positive direction, once they refinance with alt lending, we'll see an increase of those FICO scores anywhere from 50 to 150 points within 6 months. That's a significant number. That could take a subprime consumer into a prime consumer,
Right.
which completely changes everything in their lives.
And that's incredible. And that's a story that when you're looking at this type of strategy, you do not first think of the actual underlying borrowers and the lives that are changed with the sort of thing that alt lending is doing. But now shifting slightly to risk management, which is always a sort of a big concern for investors. And again, questions that we do receive quite often. And acquiring the loans is only really the first step. Although you have gone through that underwriting process, you've also received the 2, maybe 3 escrow payments from those borrowers as well. So how do you service those loans ongoing as well?
So we're a little bit more of an untraditional servicer due to the consumer type that we are working with. So our consumer, we very much need to be in front of them to ensure that those payments are made. The first thing we do is we require the escrow payments that you had mentioned. When we refinance them, we require them to stay on an ACH program. So whatever they need to do, if their monthly payments were $150 in escrow, those payments continue when they get into our loan. So the escrow payment is going to be the amount of the borrower's ongoing payment. The great news with escrow payments is on day one, we take that amount off their principal balance. So if you owe $10,000 and you made 2 escrow payments, we're immediately decreasing the balance of the loan to $9,700. That is a huge impact on that individual because they're seeing progress of getting these loans paid down. So ACH payments, the first. The second is, what I mean by non-traditional is not only do we email statements, we also mail statements. I know that sounds crazy, but there's a physical, you have to physically get the mail. You physically see the company name and you physically get a statement. We also very much congratulate the borrower on the progress that they're making. It's really important to remind these borrowers that you had a $10,000 loan and a year later, you may have an $8,000 loan. And before you were seeing no progress whatsoever on that loan. So we're really hands-on servicing these individuals. If they need to change their payment dates, we're willing to change their payment dates. If we need to go in and they want to prepay and dad wants to pay on the loan and Johnny's paying on the loan as well, we will immediately take as many prepayments as possible. And what we see is these consumers is once you give them an opportunity and a real financial resolution, they will run with it as hard and as fast as they can to get that loan paid in full, especially knowing that they can't bankrupt on this asset.
Yeah, I think you're offering sort of light at the end of the tunnel and giving them progress, which I suppose is more powerful than sort of using the cane, so to speak. So what would you say the impact is of co-signers when you have those on the loan as well? The ones that might have not have previously had them.
Impact of cosigners is really important, especially if we're taking a low FICO score individual. We could require 1 or 2 cosigners, to be brutally honest, to really back this. And so it's really important that these loans do have cosigners. There's going to be a percentage of them that won't. It's the ability and want to repay, want to get out of this situation. And so the previous cosigner is now having the same positive impact as the borrower because they're seeing a positive movement in their FICO scores with the new loans. They're seeing that their previous debt is paid in full. It's no longer sitting in collections, which is a positive moving forward. Oftentimes these borrowers will add a new cosigner. So it could be a spouse. It could no longer be mom and dad. It could be grandma and grandpa. It could be any number of individuals. And so the cosigners are willing to come on because they've seen those borrowers make initial payments. So when the cosigner sees that the initial borrower has made multiple payments prior to us refinancing the loan, there's a higher level of confidence that this loan's going to get paid in full. So therefore, we're able to get a higher number of cosigners, even if the previous cosigner had a bad situation.
So just to give sort of a persona of the type of borrowers, would you be able to give an overview of sort of the average loan size, the typical interest rate they might be paying with a previous lender, how long typically they might be in default or in delinquent stage? Of course, they could be quite varied, but if you could just give us an overview of that, that'd be really rewarding.
So the average borrower is going to come in with 2 to 3 lenders, which I mentioned earlier. We're going to refinance them between 40 and 45,000. It's a pretty decent number. And depending on their loan term, it's either going to be a 3 or 5 year, 3 or 5% interest rate with a loan term of 10 to 15 years. 15 years is the exception. So it's got to be a pretty large balance loan. We will also customize the loan term to the individual based on how much they can pay. So if they can pay more than the $150 a month and we can get them down to a 7 or 8 year loan term, we'll get them down to a 7 or 8 year loan term. It's really based on the individual and what they can afford to pay. Obviously within our criteria, 10 years maximum loan term. We're really trying to get these individuals in a situation where they can afford their monthly payments.
Amazing. And then recently, of course, we've mentioned the portfolio sale, and now we've agreed the partnership to raise $15 million for the acquisition of a further portfolio. How scalable do you think the opportunity is for alt lending as a whole?
It's very scalable, simply because our partnerships with law firms, collection agencies, lenders, colleges and universities, or any private education lender out there is a key to scaling. You also have the ability to go to companies like KKR, who just acquired the Discover portfolio, and partner with them in order to essentially refinance, rehabilitate those underlying loans. We're a key piece in this particular pipeline. We also are a secondary look. So the average borrower may go in and try to refinance with a SoFi as an example. And we can partner with SoFi and actually be their secondary look. Okay, Mary Jo, you don't qualify for this loan. Let's go ahead and here's a lender that we think you will qualify with, and they'll be willing to send those opportunities over. And so between the sale of the portfolios, all the partnerships that we can set up out there, as well as the direct to the consumer base is really key in the ability to scale, much less being able to partner with a big company that just acquired $10 billion worth of assets, which will obviously fill our coffers faster than we can think about it. A complete automated operational process, and very aware of where we need to settle with these individuals and try to automate as much as possible. but with the human touch, because some of these individuals are going to want to speak to somebody. And if they want to speak with one of our advocates, we're more than happy to have someone hold their hand through the whole process.
And there's actually, to give you a bit of a wild card question, we've recently had about the scalability of the portfolio. We've had an interesting question the other day about a company or a private credit fund that wasn't looking at non-performing loans, consumer loans in this particular space, and not so much student loans, maybe consumer auto loans, due to Trump's tariffs. Now, is there anything that you could perhaps comment on that?
Well, the interesting thing is because all of this is within the US, very rarely do we run into a consumer that might be living in the UK or living in Europe. There's no specific financial impact because we're getting this all from US businesses, as well as it could have been refinanced. And depending on where the trusts are located, it's still considered an US education loan. Based on the way the loan was originated, there's specific laws and requirements in order for it to be considered an education loan. And one is a US resident. So we really don't see any impacts associated with the tariffs that Trump is utilizing, whether every time he sets one, it gets pushed back another 30 days. So we'll see if it's just a negotiating tool, if tariffs are actually going to go into place, because it sounds like the US is just really trying to play ball to gain some marketability.
Exactly. Yeah, no, exactly was our response to that type of question. But Mary Jo, I've really enjoyed our conversation. Unless you've got any other final comments, we can wrap up here.
If there's anything else you need, just let me know. More than happy to jump on and have conversations. And if you get one-off questions from your potential investors, myself as well as my team are always available. As you can see, we try to respond pretty quickly. We'd be more than happy to answer any questions that you might have as it comes along.
Thank you, Mary Jo. And as always, thank you for your transparency now and during our time and our partnership. And we very much look forward to the progress we see in the near future.
Appreciate your time. Have a great day.
Thank you.